Nicola Shoetraps joins me in the studio, an expert when it comes to all things mortgages from the Mortgage Hut. Good morning.
Hi, Alan.
Are you going to be watching Gladiators?
Of course.
Okay. Did you watch? You're too young to have watched the first incarnation, aren't you?
No, I'm not too young, but thank you.
You remember the first?
I do, yeah, absolutely.
Oh, great. Yeah, did you have a favourite gladiator then?
Jet.
You even had a favourite gladiator. Oh, I love it. Excellent. Now, absolutely no one will be interested in this, but I'm going to tell you anyway. Would you like to know some of the names of the new gladiators?
I'll go for it.
You got Apollo.
Mm-hmm.
A good-looking Greek god kind of gladiator.
Sounds hideous.
Dynamite. Yeah, nice. Electro.
Like it.
Yeah, you're going to like that. Phantom. You know, slightly shady, hooded coat, you know, that sort of thing. I think it's going to be good.
Who's the baddie?
I, as yet, don't know the characters, so we're going to have to wait and see. Excited about it. But we're not really here to talk about gladiators, and that isn't your expert field.
No.
Although you do sound knowledgeable about it. Let's talk mortgages. There are two things that kicked off this year. The first one was Luke Littler playing darts. The second one was the mortgage market. Now, I'm a bit irritated with the mortgage market generally, or perhaps it's economists generally, because we follow this quite closely on the show and we're constantly told things, although they're predictions, that don't seem to be happening. For example, that interest rates and everything would stay high at least until 2025, but that already looks like it's wobbling slightly with the banks changing their mortgage offering. So give me a quick recap of what you've seen in the opening days of 2024. What's the mortgage market been doing?
So we've actually seen some really positive shoots in the early days of 2024. Lots of the big lenders have slashed their rates by up to sort of 0.8%. So, you know, not the 0.1s that we've been seeing. And this means we've now got around 10 lenders that are offering rates that are lower than 4%. Which 18 months ago, you know, we would have said was crazy that they were going to be at that rate. So that's really good news, and that's them predicting that rates are going to keep, you know, falling. So they're kind of pricing in for the future. We have seen that consumers are they've kind of realised this is the new normal. So last year, lots of people were waiting, thinking that rates were going to fall. Maybe more than they have, and they were waiting. But we've certainly felt like this year. You know, in the early days, people have realised this is the new normal. We've just got to get on with it. There are not lots of alternatives. We even had 14 inquiries on Christmas Day for people wanting to talk about mortgages. So, some really, you know, positive things. Those people that are coming up to remortgage, it is going to be more expensive, but not as expensive as if they'd had to do it last year. And for those that are looking to purchase, you know, it's a little bit cheaper and, you know, it's going to make it just that little bit easier for affordability.
I'm going to say something mean, Nicola. I'm not a mortgage advisor. You can push back on this. But when I look at it, it looks like the banks do this. They have a very high standard variable rate that terrifies most people, and it drives most people then into choosing a fixed rate product. They don't offer anything really in between. They say, well, look, you can pay 8% if you want to take a chance and maybe have a tracker, or you can take a 4.5% 2-year fixed. And it feels like there's not much in between. It's quite a bullish market.
Well, as you said in your previous statement, all of these economists and these predictions, they are rarely right, and that's because there are so many variables out there. You know, the bank, if they are putting you on if you want to go onto a variable rate, they're saying you can take the risk, and if rates come down, you know, your payments will come down. Most people are quite risk adverse, especially when it comes to a house, which is going to be, you know, the biggest payment normally that you've got going out. So they'd rather know that their payment is fixed. And that, you know, we've seen that work in both ways. In the last 18 months, when rates have risen as they are, banks are going to have been losing out on those fixed rates. So it does work both ways. There are some other mortgage options which have, over the last 18 months, have become, you know, much more popular than they've ever been. Previously, we were doing about 95% of 2-year fixed rates. And now we've got lots of products like trackers, discounted rates. So that's a discounted tracks either the Bank of England base rate or the bank standard variable rate. Some of them have caps and collars, so they can go down to a certain point or up to a certain point. So there are other options, and they've definitely been
caps and collars.
Yeah, well, like I say, they weren't very popular before because people just wanted that security of knowing their payments.
So a caps and collars is when you go, because you can do this with share prices and
That's
things.
right.
You can cap and collar a share price.
Yes.
So you would say, okay, I'm going to follow the Bank of England base rate to a maximum of 2% either way. Is that the sort of thing you can do?
Absolutely.
And then when it gets to that maximum, you either hit the maximum and stay there, or your product has to change.
Yeah, absolutely. And there's lots of different sort of variations on that.
You sell many of those,
No.
do you? I mean, you've got to be pretty wild. That's the wild west of mortgages.
The risk takers out there, yeah.
I'd like to be phoning up going, I want a caps and collars. What you got? That sounds fantastic. But I guess most people, like you say, it's the biggest bill that they're going to have, and you want it, where possible, predictable.
Absolutely. And we've seen a real switch in people switching from 2-year rates to fixed 5-year rates, because a lot of them have been on that 2-year rate, come out of a 1%, gone on to a 5%, and been terrified and haven't
You
wanted.
wouldn't do a 5-year now, would you? Look, if you looked at this year, 2024, surely you're looking at it thinking, we just had the economy figures up by 0.3%. That looks quite good. Sure, we've got the Red Sea and everything that's happening there, but not sure it's going to quite have the same impact as what's happened in Ukraine. So you might think, okay, Bank of England, we've got the premium bonds are changing already, which is usually an indication that they think the interest rates for the Bank of England base rates are going to change. Surely you're thinking now these rates are going to get better.
Absolutely. And last year we saw a huge increase in the number of 5-year fixed we've done. And now people are talking about 2-year fixed again. Those people that have been caught out last time round, though, where they've come out 2 years ago, nobody thought rates would be where they are now. So it's definitely scared people and made people realise that they can't guarantee that their rates are going to stay as low as they are and their payments as low. So there's definitely a mixture of 2 and 5 year. But agreed, rates, the trend is that they're going down. We've got a general election coming up. It's still unpredictable, and anything can happen is the truth.
I'm wondering, Nicola, and thank you for coming in. You're listening to Nicola Shoetrops, is a mortgage advisor of the Mortgage Hut, which you can find online. I'm wondering whether, if it goes down and down, whether more people might grab a 10-year fixed. Because we've been through a period of low inflation and relatively cheap money. And we've seen it it never got below 1.99% really, did it? Apart from some special stuff. I'm wondering if it ever got close to that again, whether people would go, I've been here before, I'm going to try and get the longest fixed rate possible.
Yeah, I absolutely think they would. And lenders are changing their products. We've got some lifetime fixed rates now, which are fixed for the lifetime of the product, which mirror much more the US market, where they don't do the 2 and 5 year fix. So, yeah, I know some very smug people on 10-year fixed right now on sort of 2%. So I think people's attitude towards rates and fixing and what is normal are definitely changing.
Yeah. Do you know how you tell when someone is on a 10-year fixed rate mortgage? Do you know how they tell?
How's that?
It's easy. They tell you straight away. Nicola, lovely to have you in the studio. Thank you very much indeed for that. You can listen back to what Nicola's just been talking about with the bits and pieces that are out there in the rather complicated mortgage market. Grab the BBC Sounds app, move the cursor back ever so slightly, and you can listen again to the beginning of the interview on that app. It's 7:59.